All right, good morning, everyone, and welcome. If you have your syllabus for our Accounting for Decision-Making course handy, you'll see we're diving into a really critical piece of financial analysis today, the statement of cash flows. Now, look, the income statement and the balance sheet, they're absolutely essential, no question. But I'll always argue that the cash flow statement, well, that's where you find the real story of a company. We're going to zero in on one specific part, cash flows from investing activities. And this section is fascinating, truly, because it's where a company's long-term strategy, its big money decisions, and its whole vision for the future, it's all laid out in black and white.
So, here's our game plan for today. First, we're going to tackle the cash flow puzzle and really get a handle on why this statement is just so fundamental to business. Then, we'll move on to defining investing activities, where we are going to nail down the precise accounting definition. After that, we get to see a business in action. We'll apply all these concepts to a practical case study. From there, we'll learn how to read the strategic story, how to interpret what these numbers are really telling us. And finally, we'll look beyond the numbers and talk about some common traps that can trip up even experienced analysts. Sound good? Let's get started.
Okay, let's start at the beginning. Before we can even think about the investing section, we have to appreciate the role of the entire statement of cash flows. I want you to think of it like a company's checkbook for a certain period, say a quarter or a year. It's simply a record of every single dollar that actually came into or went out of the company's bank accounts. Now, this makes it fundamentally different from the income statement. Remember, the income statement is built on what we call accrual principles. That means it recognizes revenue when it's earned, not necessarily when the cash hits the bank. And it records expenses when they're incurred, not when the bill is paid. The cash flow statement, it just cuts through all of that. It is brutally honest and simple. It's all about the cold, hard cash.
And that is exactly why this statement is so important. A lot of students are shocked to learn that a company can report a huge net income, look incredibly profitable on paper, and still go bankrupt. How is that possible? Well, if it doesn't have the actual cash on hand to pay its bills, to make payroll, to pay its suppliers, to make a loan payment, it's insolvent. Game over. This is why we have a saying in finance, profit is an opinion, but cash is a fact. Understanding where that cash is coming from and where it's going is absolutely fundamental to figuring out the true health of a business. It really is the pulse of the company.
Okay, so the statement of cash flows is neatly organized into three sections. You've got operating, you've got financing, and then you have our focus for today, investing. Now, if you think of operating activities as all the cash from the company's main day-to-day business, making and selling its stuff, then investing activities are all about the company's long-term strategic bets. This is the section that really shows you where management is putting its money to grow and shape the company's future. Let's really break this definition down. The key phrase I want you to focus on here is long-term assets. In the world of accounting, these are things the company plans to use and benefit from for more than 1 year. So we're not talking about inventory they're going to sell next week. We're talking about the big, foundational, productive stuff, what we often call PP&E, property, plant, and equipment. This could be a manufacturer buying a new factory. It could be a tech company buying a whole rack of new servers, or a logistics company buying a new fleet of trucks. And it's even broader than that. It also includes buying or selling things like patents, or making financial investments in other companies, like buying their stock as a long-term strategic move.
So all of these activities create one of two things, a cash inflow or a cash outflow. It's a two-way street. As you can see here, we've got two columns. On the left, you have your inflows. These are sources of cash for the company. This happens when the company sells a long-term asset like an old building or sells some stock it owns in another company. And on the right, you have the outflows. These are uses of cash. This is just the opposite, buying that new building or buying those stocks. Now, I want you to pay very close attention to that bottom row about loans. When a company lends money to someone else, that's seen as an investment, so it's a cash outflow. When the company gets that original loan amount, the principal, paid back, that's a return on its investment, so it's a cash inflow. But, and this is a critical distinction, the interest it gets on that loan, that usually gets classified under operating activities. Why? Because earning a return on your money is considered part of your main operations. The loan itself was the investment.
All right, theory is one thing, but it only gets you so far, right? Application is where this stuff really starts to click. So let's move away from the abstract textbook definitions and into the concrete by looking at a hypothetical company. This will let us see exactly how these principles play out in a real business scenario. So let's meet Apex Manufacturing. They're a growing company, they've had a couple of really good years, and management has decided, you know what, it's time to invest in our future.
Their big goal is to increase their production capacity and get more efficient. And this strategic goal is what's going to drive the decisions that we, as analysts, will see on their statement of cash flows.
So during the year, Apex makes two big moves. First, they buy a brand new, state-of-the-art robotic assembler for their factory. This is a textbook capital expenditure. It's a long-term asset they expect will improve their business for years and years. That's a cash outflow. Second, to free up some space and get a little cash, they sell an old delivery truck that wasn't very efficient anymore. This is a disposal of a long-term asset, and that's going to result in a cash inflow.
Okay, this table sums it all up for us perfectly. You can see the purchase of the assembler is a negative $500,000, a cash outflow. The sale of the truck brings in $25,000, a cash inflow. So when we net these two out, we add the positive $25,000 to the negative $500,000, we get our bottom line, a negative $475,000. Now, the official accounting term for this is net cash used in investing activities, and that word used is so important. It tells you immediately that on balance, the company spent more cash on long-term assets than it brought in from selling them.
Okay, so we've got the number negative $475,000, but as future business leaders, your job isn't just to calculate a number, it's to interpret it. What is this number actually telling us about Apex? What's the story here? This is the moment we go from being bookkeepers to being analysts.
And that brings us to a really crucial question. When you're looking at a company's financial statements and you see a big negative number in the investing section, what's your gut reaction? Is that good? Is it bad? Is the company in trouble? The immediate and correct answer for any smart analyst should always be, well, it depends. The number itself doesn't tell you the whole story. Context is everything.
For a healthy, growing company like Apex, a big net cash outflow from investing is often a very, very positive sign. It shows that management is plowing profits back into the business to fuel future growth. That $500,000 purchase isn't just an expense, it's a vote of confidence in the future. It signals to investors that management believes demand is going to be strong enough to justify spending that kind of money. They are giving up cash today because they expect this new, shiny, efficient asset will generate even more cash for them down the road.
All right, to round out our discussion today, let's talk about a few of the finer points and, more importantly, some of the common mistakes that students tend to make when they're analyzing this section. Getting these details right is what really separates a novice from a pro.
Okay, I need everyone to listen closely, because this is a point where a lot of people get tripped up. You have to separate how an asset is paid for from the purchase of the asset itself. Let's walk through it. Imagine I'm the CFO of Apex. I need that $500,000 for the new assembler. So I go to a bank and I get a loan. Transaction number 1, the bank wires $500,000 into my company's account. Cash is coming in from a lender. That is a classic financing activity. Now I've got the cash. Transaction number 2, I write a check to the robotics company for $500,000. Cash is going out to buy a long-term asset. That is a classic investing activity. Do you see? The source of the money and the use of the money are two completely separate events, and they get reported in two different sections of the statement.
I want to leave you with one last thing to chew on. We've just established that for a growing company, a net cash outflow from investing can be a really good sign. But what about the opposite? What if you find a company that consistently shows a large net cash inflow from investing activities year after year? Is that a sign of brilliant management, selling off underperforming assets to focus on what they do best? Or could it be a sign of desperation? Is this a company that's selling off its crown jewels, its most productive assets, just to get enough cash to survive another quarter? See, this is the art of financial analysis. It's knowing that the same number can tell two completely different stories. And your job as an analyst is to dig in, use the other financial statements, and figure out which story is the truth. Thank you.